Danielle DiMartino Booth. She's the CEO and chief strategist at Quill Intelligence, a former advisor to the Dallas Fed, for some insight and analysis on how the markets will interpret this. I saw this morning, Danielle, it's nice to see you. I saw the markets initially decided to put some money to work on the idea that some of those other parts of the jobs report indicate that maybe there are signs of cooling in the economy. What was your takeaway?
So my biggest takeaway was actually the anomaly in January of a very long work week. So employers are working their existing employers to the bone, trying to get more out of them. 34.7 work week. That was revised down to 34.6 for January, and then it was taken down another notch to 34.4. That was my biggest takeaway. That, alongside the labor force participation rate among the 25 to 50-year-old cohort, that's your main worker, that ticking up. These are things that will give the Fed chair the ability to say, in the totality of the data, there wasn't really enough to take away to say that it was too hot or too cold. Let's wait and see what that CPI is. And again, today we go into blackout. That's what people don't appreciate. Normally we'd have another week in front of us before Fed speak was silenced. But because this employment report fell so late in the month, we're actually going into the 10 days of blackout ahead of that March 22nd critical Federal Open Market Committee meeting.
Yeah, and you mentioned CPI, so we get inflation numbers for the United States next week, and the market will chew on that. And then you highlighted that later this month, we get that decision on interest rates. Now, we just saw, I was talking with our previous guest, Derek DeClute, about this. The Bank of Canada has a very clear message right now. We're going to take a pause and see how things play out from here. But Jay Powell was pretty clear this week, to your earlier point, that he's ready to keep hiking. And, you know, I guess at this point, what do you think are the pros and cons of continuing with interest rate hikes in the United States?
Well, certainly, as we're seeing play out in the commercial real estate sector over the past month or so, but in the more immediate sense, what we're seeing playing out in terms of the lag effect, how that affects the banking sector. And we're starting to say, oh, people are starting to use the words dominoes. You know, what bank is next? Is it the First Republic Bank of California? I hadn't heard of that until this morning. And yet that's what happens when there's long and variable lags to monetary policy, and you're rounding that 1-year anniversary to when the Fed first started hiking. Things inside of the financial system start to break. And that becomes a lot more important than one payroll print or one consumer price index print that had been so front and center just 48 hours ago. And
so at the end of the day, then what do you think is in the mind of Jay Powell? We were talking with the longtime economist David Rosenberg yesterday. He doesn't get it. He does not understand why there is still this extremely hawkish rhetoric, and also this obsession with getting back to 2%. I mean, he was using examples of past economic cycles where having inflation levels that were above 2% worked okay for the economy and even for the markets.
Well, and I'm very good friends with Dave. Where he and I maybe don't agree is that Jay Powell may have, or at least he may think he has, a higher calling, and that is to break the dependency of stock market investors on the Fed always riding to the rescue and having their back. So if there's this higher mission, if you will, then Jay Powell's going to hide behind data that are hotter than you would think. He will say, okay, so the unemployment rate in the United States went up from 3.4 to 3.6% in February, still one of the lowest rates in 75 years, as he reminded the Senate on Tuesday. So as long as he is taking the tack that he wants for Wall Street to quit demanding how the Fed sets interest rate policy, then I think he's going to go for higher for longer, which in our generation, we're just not accustomed to.
Yeah, you're right about